Hello and welcome everyone to October's monthly discussion meeting. Today we're going to go over inflation and the drivers of inflation. So between supply and demand and the labor market, we'll talk through how these have affected and will continue to affect inflation, as well as a fun topic. We're going to talk a little bit about crypto and how the effects of between Congress and inflation affect your portfolio. So first, let's talk about the winners and losers year to date that have to do with inflation.
Yeah, so if we focus on the winners and losers, we can see that the industries that typically perform well in inflationary environments are energy, financials, real estate, and basic materials. Those are the bars highlighted in gray. And you can see with energy prices more recently, whether that's the cost of gas or the cost of heating, all of those are up, and you see that they can fluctuate pretty regularly. Real estate, which is typically a hard asset or something you can hold, essentially does really well in real estate because as in an inflationary environment, because as you see prices go up, the cost of real estate performs well in that situation. And then when you look at financials, they typically loan out money at higher rates than they're able to borrow, and so they perform well in an inflationary environment because they're able to work the spread between the rates at which they borrow from, for example, the federal government or from investors, and make loans for a mortgage, for example. So those industries typically perform pretty well. The one that we haven't seen do as well, but would expect to perform well in an inflationary environment, is basic materials. Still up nearly 16% for the year, just not as good as some of the other categories that you can see, communications and technology. So JR, as we look ahead to the earnings season and some of the earnings that we've seen, are you seeing those results in the reports?
Well, if you look, we're on week 2 of the earnings season, and this is exactly what we're looking for is the trends you went over. Will the year-to-date performance that we just looked at continue? I mean, that's the million-dollar question as we look at it. And so far, when you look at the earnings season between the big banks and financials overall, it's exactly what you said, David. I mean, the results have been fantastic. The outlooks have been very strong. The fee-based revenue, the mergers and acquisitions, you name it, the outlook is very strong. And financials continue to look favorable from a valuation and outlook standpoint. When you look at commodities, same thing. Commodity stocks, the few that have reported already have been fantastic, and their outlooks are even better. And the valuations in both cases are much, much cheaper than the rest of the market. So as we look ahead, if the inflationary environment continues, so far what we've seen in the first 2 weeks of the earnings season, look bright ahead. Now kind of turn to the next week or so be tech earnings. So you look at the trend most recently, interest rates have gone up. So how will that impact the valuations of tech? Because the results themselves will probably be pretty good. We'll see what the supply chain does for some of the big tech companies, specifically in the phones and semiconductor area. So we'll see kind of how those look ahead and see if we need to adjust. But so far so good with the trend of the inflationary environment as we look to week 2 of earnings.
I think you touching on that point, Jer, is so important, which is the supply chain. We see the bottlenecks out there between the railroads, the ports. We hear the stories constantly that everything is so backed up. And with the pent-up demand that during the pandemic, and the savings rate is so high today. So between supply and demand, there is that issue with supply chains being able to deliver to the consumer what they're asking for. And even, let's say, as spooky as that may sound today, I still believe that and hopeful that this will drive innovation and competition in the market.
Well, you look at the supply chain overall and the innovation that will likely fall or come in the future because of this is you just don't want to be stuck without being able to deliver your products and things. But when you think about the supply chain specifically on where it's going to be impacted more, so let's just take an example between lower end goods and higher end goods. So if you're taking a purse, for example, if it's going to cost an extra $20 to ship a purse, is that going to be felt more at the $100 or $50 price point, or the $10,000 price point on the very, very high end? And when you look at it, it's just a percentage difference or percentage of the product. So as we've seen in a few earnings reports, there's a larger impact to the inflation or supply chain at the lower end goods because it's a much bigger percentage of the product. and tied to the consumers. And that's a trend we'd expect to continue ahead, is that luxury goods will probably hold up better in this inflationary environment or less of an impact.
And I think if we move over towards not a product, but a thing that we do every day, right? We go to restaurants, or well, we used to go more often than not. But then how is that supply chain affecting restaurants today? Or should we better say, is it the labor market?
Well, what's interesting about the restaurants, and you look at the three charts we're looking at here, is clearly there was a big drop off when restaurants were basically closed during the pandemic last year, and you can see that on the left. What's interesting is restaurant revenues are above pre-pandemic levels, and you can see how quickly that came back. And really what restaurants have been able to do is expand the market. So there was always a takeout and delivery component of many restaurants that surged in the middle of the pandemic. And as restaurant dining rooms have reopened, a lot of that business has not gone away and has stayed at a similar level for takeout and delivery. You can see the challenge in the other two graphs, right? The labor force has not come back. So what's happened with a lot of restaurants is margins. Think about it. How can you do more business with fewer workers? So you have to make your existing labor force work longer. So it's overtime and other items like that that have hurt the margins within certain restaurants and models out there. And that's really a challenge for certain business. When you talk about losers in this environment, are companies that aren't doing as well. The ones that aren't able to pass along the price increases have to have more overtime, are impacted more by the supply chain. Those have been the companies or the areas to really watch carefully in this environment, because it's a big challenge.
It seems like it's a roller coaster in restaurants, but another roller coaster ride that we've seen every single day that has a 24/7 market is cryptocurrency. So just being specific with Bitcoin, if we look back on March into 2020, the price was $5,434. It would seem incredible to say that today it's at 62,000. But regardless of the ups and downs that we can see on the chart between when it went from 5,000 to 65 and then dropped drastically back down around 30 when China decides to say they will not allow it, look how quickly it was able to shift on October, the beginning of October, just based off the anticipation of having an ETF that has Bitcoin futures, that this will be allowed. Is it that thought that now it will be accepted in more places and that's the rally? Will this continue?
Well, if you think of what's behind that, there's a bunch of things. I mean, there is a lot of speculation and a lot of excess in the crypto markets overall. But if you look at short and big picture trends, the Federal Reserve has printed trillions of dollars since the pandemic started. That went into all risk assets, real estate, stocks, bonds, and crypto, right? So the crypto markets have clearly benefited from the amount of money that's been printed, and all risk assets have gone up. The ETF begs the question, is this the SEC in the US kind of a quasi approval of crypto in the US and really moving to the next step, which would be regulation and integrating into the banking and financial system officially? It's almost a $3 trillion market overall, so we feel that's very likely ahead. And it's just an area that is ripe for innovation overall. There is a lot of speculation and problem, but it is here to stay, we believe. And it's really a matter of understanding a little bit more. We've spent many, many months in the last 6 to 12 months really understanding as a team and doing more education within our group to understand it a little bit more. And you look at the future of where things are, there are a lot of practical uses for crypto, smart contracts and other things that are going to change many industries. And it's, again, to use a baseball analogy, we're probably in the second inning. There's a long, long way ahead. And many of this is going to be used for cost savings. You look at technology platforms, the ability to use blockchain for better security and managing that is going to allow companies to take a lot of cost out of their system. And if we want to run through a sort of an interesting practical example, David, on kind of a smart contract, I think an interesting discussion that might follow after.
Yeah, and I think, Jared, as you mentioned, kind of the impact of the growth in that market, it went from, not so large just in recent memory, right? So less than 500 billion maybe total, and now is, which I guess still pretty significant, but now is well above 3 trillion. If you look at that money coming back into the traditional banking system, people who would be, for example, liquidating some kind of a coin, whether that's Bitcoin or another one, where they would have potentially made some money, they could then go out and buy a house or a car, and that then makes its way back into the system. So there is, between the government printing a lot of money and crypto assets making their way to the traditional financial system, that's driving some increase in costs. But Jerry, you mentioned innovation, and so here's kind of one example that we've seen. So there's a lot of different use cases for blockchain, which, as you mentioned, can be security, logistics, or others. But here's an example. The next time you're out there buying a Rolex watch or really any product, a lot of these products now come with a digital certificate. So you get what's called an NFT, a non-fungible token. And right now, I think it's in the luxury goods space, but it's making its way into other areas as well. But if I was to go out and buy this watch, I would get a digital certificate of authenticity. It would live in my crypto wallet. And so if I was to ever then, let's say, go forward and resell it to somebody else, they would have a way to be able to make sure that what I'm selling them is authentic. And the same example you mentioned for that purse, right? You said if you buy something and it's $10,000 and you want to make sure that it's authentic, it comes from the manufacturer who made it, as opposed to some forged item, right? So especially as you get into art, collectibles, and then even down to to your vehicle, right? And if you think about logistics, you can think about the concept of ESG, environmental, social, and governance. Right now, I think there's a big push for making sure that the products that we get are ethically sourced or locally sourced, or just knowing where that product comes from and taking out some of the ambiguity. So that blockchain will allow you to see that the input went to the factory produced the item, and the item made it to your to the end consumer, and you kind of have a sense of where it is that it came from, and you have a better understanding of what's in there.
Well, let's go back to cost savings. A question would come up then, if you have a digital NFT supporting your good, what are the odds that somebody's going to want to steal that watch, that purse, that car, if they don't have the NFT to back up that luxury good, right? Because in the future, if you think about these goods, you're going to need to sell both together to verify that it's authentic. So it's interesting to see if that'll drive down insurance costs, maybe, that you won't need to insure goods as much because the theft in the future may be less. There's going to be a lot of this innovation ahead that don't know necessarily how this will play out, but that's an interesting one of the digital, the NFT to back up the goods.
Yeah, and I haven't spent a lot of time in art forgery, right, or any kind of certificates. But if you think about it, there are paper certificates that can be manipulated to make it look like it's an authentic piece of art or an authentic item, whether it's a rare collectible or a limited edition of something. This way, it's pretty clear to see if I bought, pick an item, a baseball card, and then I sold it to you, JR, and then you sold it to someone else. Odds are that the next person buying it has a better sense of, at least they see that you at some point bought the original item versus having no kind of background as to how did you acquire this item, right? So having that transaction chain, makes it very valuable.
Which is another interesting one are authors. You write a book, it's sold initially, you get the royalty. I'll think about college textbooks. You go into the bookstore, you resell that. The author doesn't get another royalty. But now if you go to this logic and you have the NFT that goes with that, each time that book is sold, a royalty would be paid to the author. So you can see how this is going to evolve over time and interesting uses as we think where it is today. Again, there's a long, long way ahead. This is still very, very early on.
So thinking about inflation and some of the impacts that can have for your portfolio, obviously we talked about the different industries and companies that are out there, but I think, for most people listening, they are thinking about, what does this mean for me, right? What does inflation mean for me, and specifically in the context of financial planning? So as we go through and think about plans for our clients and families that we work with, one of the things that we've done is always built in the expectation of inflation, but now that it's running a little bit higher, the question is more front and center. And so we'll put together a sample portfolio just to kind of outline what this could mean for a potential investor. So if you look at the three different lines, the gold, the blue, and the gray represent 2%, 3%, and 4% inflation. And then if you look at that dashed blue line, that shows the proportion of your portfolio that you're taking out. So in this case, it's a portfolio starting at $3 million, and pick your starting age. Let's say you're retiring at 65 or 70. You've worked very hard for your entire career and saved $3 million, and now you need $100,000 a year to live, indexed for inflation. So if inflation is going up at 2% a year, you can see this portfolio continues to grow. That's that gold line. So the portfolio is earning 5% a year, a very conservative rate of return, and then you're taking out 100,000 a year. So in that case, the portfolio continues to grow. At 3%, that's where you start having kind of a little bit of a question mark. It grows in the beginning, but at some point the inflation starts eating into the overall portfolio, and it ends, slightly higher than you started, but still the downward trajectory makes it a little bit concerning. And then at 4%, you see that the portfolio is starting to really invade the principal, and that's where that blue line comes in. So in that last year, if you think about year 25, when you're 90 or 95 years old and you're taking out money from your portfolio, you're taking out at a rate of roughly 12% a year, which is pretty hard to maintain. So building in appropriate inflation assumptions, I think, is very important. But if you look at it in this case, this portfolio starting out at $3 million and taking out $100,000 a year ends up with either more money than it started with, in most cases, or in some cases slightly less. But the inflation is not impacting it in such a way that the portfolio can't sustain you through your retirement. So it's good to see that. It's good to test it in the portfolio. But I think to kind of, take out some of the concern and reduce some of the fears, and we'll do that as we go through financial plans with people that we work with. But to do that, I think it gives you some comfort to know that even if inflation runs a little bit higher for a couple of years, then again, this case was 25 years, right? But if it runs higher for a couple of years, it's not going to have that kind of catastrophic impact that people are concerned about.
And when you think about inflation in the long run and its impact, equities are going to be your best long-term place to hedge between that and real estate and hard assets. So if we do remain in this high inflationary environment and you look at the trends of where we're looking to shift short-term versus long-term, the issue is just staying on top of that plan and adjusting and making sure you're not too conservative, you're not too aggressive, and you stay on track. So as we look at kind of what's going on in the world and the earnings, we're very cognizant of the inflation and what could change ahead. So with that, we want to thank everyone for watching, and we'll talk again next month.